The quick ratio is a crucial liquidity metric used to evaluate a company's ability to meet its short-term liabilities without relying on the sale of inventory. It is also known as the acid test ratio and provides a more stringent measure of liquidity than other ratios like the current ratio because it excludes inventory from its calculation. This is because inventory can be less liquid and may not be easily converted into cash quickly. Quick ratio. The quick ratio measures a company's capacity to cover its current liabilities using its most liquid assets. Unlike the current ratio, which includes inventory in its calculation, the quick ratio focuses on assets that are quickly convertible into cash, such as cash itself, marketable securities, and receivables. This makes it a more conservative measure of a company's short-term financial health. To calculate the quick ratio, start with the company's liquid assets, cash, marketable securities, and accounts receivable. Add these amounts together. Then, subtract the company's current liabilities from this total. Finally, divide this net figure by the current liabilities. The result is the quick ratio, which indicates how many times the company's liquid assets can cover its short-term obligations. Example: suppose a company has cash of $50,000, marketable securities worth $20,000, and accounts receivable amounting to $30,000. The company's current liabilities total $60,000. First, add the liquid assets. $50,000 plus $20,000 plus $30,000 equals $100,000. Next, subtract the current liabilities from the total liquid assets. $100,000 to $60,000 equals $40,000. Finally, divide this by the current liabilities. $40,000 slash $60,000 equals 0.67. Thus, the quick ratio is 0.67, meaning the company has $0.67 in liquid assets for every dollar of current liabilities. Low quick ratio. A low quick ratio indicates that a company may struggle to meet its short-term liabilities using its liquid assets. It suggests potential liquidity problems and might imply that the company is over-reliant on inventory or other less liquid assets. This could be a warning sign for investors or creditors about potential cash flow issues. High quick ratio. A high quick ratio indicates that a company is well-positioned to cover its short-term liabilities with its liquid assets. It reflects strong liquidity and financial stability, suggesting that the company can comfortably manage its obligations and potentially weather financial difficulties. However, excessively high ratios might also suggest that the company is not using its assets efficiently to generate returns. How can companies optimize the quick ratio? Improve receivables collection. Accelerate the collection of accounts receivable to ensure that cash is available to cover liabilities. Increase cash reserves. Maintain a higher level of cash and marketable securities to enhance liquidity. Reduce current liabilities. Strategically manage and negotiate shorter-term liabilities to improve the quick ratio. Key takeaways. The quick ratio is a vital measure of a company's liquidity and ability to meet short-term obligations without relying on inventory. It provides a more stringent assessment of liquidity compared to the current ratio. It is calculated by dividing liquid assets, cash, marketable securities, receivables, by current liabilities. A low quick ratio indicates potential liquidity issues, while a high quick ratio suggests strong financial health. Companies can improve their quick ratio by optimizing receivables, increasing cash reserves, and managing current liabilities effectively.